Have you ever wondered why some investors lose funds while others make significant gains? The truth is, investing in stock is not guesswork, it's not gambling. There are basic principles and fundamentals that guide successful investors. One mistake people make is buying stocks based on hearsay. You go to social media, people are hyping a particular stock, then you put your money inside. You end up regretting it. If you've ever experienced all that, you're in the right place. First of all, my name is Onye. I'm a chartered banker, chartered accountant, and I hold an MBA in finance and investment. I have over 8 years experience in the financial service sector. So I'm going to be your guide today. We're talking about everything stock. Over the years, I've helped several investors understand how to identify the right stocks and avoid costly mistakes. In this video, I'll show you how to identify profitable stocks, the difference between growth and value stocks, how to evaluate a company before you invest, and most importantly, when to buy and when to sell your stocks. Before we continue, please like this video and subscribe to my channel if you're new here so you don't miss any future investment insights. I share things relating to investment, finance, money, remote jobs, just basically how to earn passive income in 2026. So first of all, let's dive in. What is stock? It represents ownership in a company. When you buy a stock, you're essentially buying a small portion of that company. That means if the company performs well, company grows and becomes more profitable, your investment increases. If the company performs poorly, the value of your investments may decline. So as a shareholder, you earn in the stock market via two ways, what we call capital gain and dividend. Dividend is like a cushion, like the cash that is paid to you real time. Some companies pay dividend twice in a year, once in a year, 4 times in a year. It just depends on the company. So your part of the company's profit is being paid to you as an investor. While capital gain can only be realized when you sell this investment. So the difference between the buy amount and the sell amount is your capital gain. For example, if I buy a company's share for 60 naira and after 6 months it's 100 naira, I've gained 40 naira, right? But this gain is not realized yet. So when I sell this share, that's when I'm going to realize the gain. That's why I said you realize the capital gain when you finally dispose or sell these shares. I'll be sharing 6 valuable steps to consider before you invest your money in the stock market. Step 1, your investment percentage. This should serve as a guide. If you're below 25, invest more in stocks. You can do above 50%. But if you're within 25 to 40, don't exceed 50%. If you're above 60 years of age, invest more of your assets in low risk earning assets, right? Because the younger you are, you can accommodate more risk. Step 2, diversify your investments. So this one is very important. So diversification means you're spreading your investment across different industries. This reduces your risk because if one sector performs poorly, another sector may perform well. For example, if you have 500K to invest, you should spread it across at least 3 different sectors. Examples of sectors in the Nigerian Stock Exchange include financial service, Zenith, Access, FBN, agriculture, Okomu Presco, FMCG, fast-moving consumer goods, Cadbury, flour mills, PZ Cushions, insurance, telecommunications, pharmaceutical, energy. Just make sure that your investment is spread across 3 different sectors. I usually say, please consider one of these 2 sectors, FMCG or pharmaceutical. Pick one stock from these 2 sectors. It's very necessary. Step 3, understand the business. This one is very key. Before you buy any stock, you should be able to explain the company's business in one simple sentence. If you cannot explain how the company makes money, you probably should not invest in it. But I have like some companies I try to analyze, I don't understand the business, so I don't even bother investing. Example, what does MTN do? MTN provides telecommunication services like your voice calls, data, and digital services. What does any bank do? Provide financial services like loans, deposits, and payments, same as FBN. So if you cannot explain what a company does, that means you can't even explain their source of revenue. Step 4, Check the company's fundamentals. Fundamental analysis helps you determine whether a company is financially strong. You can find this information on platforms like Yahoo Finance, investing.com, TradingView, stock analysis. I personally use stockanalysis.com. So know what that means. You don't even need to do the analysis yourself. You go to this site, search the companies, then do the analysis. Like I said, we'll be analyzing one company just to show you how to do this analysis. So what are the key fundamentals to check? The basic one is revenue. Revenue just means the money the company makes from their core business activities. A good company should have consistent revenue growth over time. If a company experiences 2 consecutive years of declining sales, it may be a warning sign. Do not invest in this particular company. Right? So a company should have consistent revenue over time with a period of at least 5 years. The next one is profit margin. Profit margin shows how much profit a company makes from its revenue. So after reducing its expenses, what is left for us as a company? Example, if a company's revenue is 100 million naira and the expense is 80 million naira, so the company's profit approximately is 20 million naira. So that gives us a 20% profit margin. Let's interpret this profit margin. Above 20% is very excellent. 10 to 20% is good. And then once the profit margin is below 10%, it's weak. We are not investing in that company. No, we are not picking it. As a beginner, it's safer for you to invest in companies that are already profitable. The next one is balance sheet. Balance sheet shows you the financial health of a company. It shows you the financial health of a company. It includes assets, what the company owns, and liability, what the company owes. Then you have equity, the shareholders' ownership. What you should check in a balance sheet are the debt levels, the cash reserves, and the current ratio. The next fundamental analysis is free cash flow. Free cash flow is the cash remaining after a company pays its operations and investments. So companies with strong free cash flow can pay dividends, can reduce debt, and expand their business. Step 5, company valuation. Even a great company can be a bad investment if you overpay for this stock. The first thing you are considering in valuation is price earning ratio. The PE ratio tells you how much investors are paying for 1 naira of a company's earnings. Example, if a company has a PE ratio of 10, it means that investors are paying 10 naira for every 1 naira of earning. Is it a good thing? Is it a bad thing? We'll find out in this video. For PE ratio, you have to compare PE ratio of similar companies in same industries, right? So you compare PE ratio in isolation. So you have to get the average PE ratio of the industry to compare. Like technological sectors, they have high PE ratio because people prospect that is the near future, so they are paying more for it. So it doesn't really mean that it's a bad thing. So you have to analyze that particular company relative to its industry. So if that company is the company that has a higher PE ratio relative to the average, that means the company is overpriced. We will not buy the stock. Do you understand? So you have to compare banks with banks, compare telecoms with telecom companies. Yeah. So the next valuation metrics we are looking at is dividend yield. Dividend yield shows how much income you earn from dividend relative to the share price. That's very important. So it's not by saying this company paid 40 naira per share as dividend, another company paid 100 naira per share as dividend. You have to compare relative to the share price because the share price determines the number of shares you could buy in this company. And dividend is paid on a number of share basis. That's why it's called dividend per share, per each share that you own. Do you understand it?
You can see Access has a higher dividend yield than Dangote Cement.
Watch this essence. I just hope you've subscribed. Please subscribe and like. I'm pleading. Step 6, markets and industry analysis. Finally, evaluate the industry itself, not just the company in isolation. Is the industry important in the long term? For example, telecommunications will always be important because people need data and connectivity. In fact, healthcare and pharmaceuticals, they are essential to human survival. Energy companies remain critical to economic activities. You should also check the stock price performance over time. It's part of your market and industry analysis. How do we check this stock price performance over time? So we'll be checking 6 years, 5 years, 1 year, 5 months, 6 months. We're just checking how has this company's share price been over the years. How has the company performed in previous years in relative to its share price? If you still feel confused or you're unsure about selecting individual stocks, you can just invest in equity mutual funds, right? You can download any of your fund managers app, Stanbic IBTC, you have the ARM, you have the Meristem, Invest Niger. Go to the mutual fund aspect, click on equity mutual funds, then invest in equity mutual funds and let the fund managers do their work. They are the ones that select these stocks for you and invest. So they don't invest in one stock, they invest in pool of stocks. And you can start with as low as 5,000 naira. Start investing in stock.